It is nice having my camera back on my desk for once. I've been so used to having the tripod here, the opinion corner, the this, that, the other. Finally, we're back where we belong. And today, obviously, we're going to be talking about the trading 212. They call them pies. I'm calling them funds because it just sound more interesting. So it sounds a lot more intellectual when I call them a fund. I was going to do my portfolio like reveal in this video, but instead I'm going to address these two funds first and then do the portfolio next week. I'm going to record it all now in one, so you're going to see the same shirt again. But I think it's a lot more easier to communicate what I'm trying to do if I show you what I'm doing first and then give you my whole, entirety of my portfolio in the following episode. So we're finally back with some finance content, and I'm going to go straight into my phone here because basically all of what I want to show you is in Trading 212, which is an app which I have on my phone, which should be going in 3, 2, and 1. There we go. So as I say, I've got a lot of stocks and I've been trading. Well, I haven't really been trading. It's more like I call it investing. I have tried trading once with like Forex. Didn't go very well. So now we're straight back into the world of investing, which is more long term. It requires a lot more research, I guess, because when you kind of trade, it's more like day trading, or it's a bit more quick, a bit more fast paced. Whereas because I know it's like I'm trying to hold, for example, Tesla for the long run, I don't really care about short term results. I care about where's it going to be in 5 years time, 10 years time, whatever. The same with like Apple and anywhere else that I'm investing in, and basically that. But when it comes to this video, obviously some of you guys will know that 2 weeks ago, maybe even last week, I put out a video called "Why I'm No Longer Investing." And check that out if you want to know more about that. But fundamentally, I've invested so much in the past, and I put so much money in savings accounts and bought a lot of things that, even though I'm quite sad with my money, even though I still do have cash around, I would like to have an emergency fund that will last me about 6 months. So like, if something were to happen, if I were to like not get a student loan, if I were to I haven't got a job, if I were to have a job and get fired, or if anything were to happen, or if there were some expenses like my car breaks down or MOT, or like any short-term expense should be covered by the combination of my savings and emergency fund, which should last me about 6 months. So I know that I spend around about £1,000 in like a 2 month spread. So if I can just have 3k put in an account and just not touch it, just have it there for rainy days only, that's when I'm going to start investing again properly. But for right now, I'm trying to just building that up so I don't have to worry about that later on when I do start investing, and that will enable me to ride out the lows. However, I kind of hinted at this in the portfolio, in the net worth video, where Aqua, one of my credit cards, they were like, you know what, if you take out, they gave me a promotion, a 6 month 0% interest promotion, where I can take out the cash, the money value of my credit card, of the credit limit on my account. And I was like, yeah, yeah, hell yeah, because now is as good a time as any. Well, to be fair, last week when I started this, it was like a massive tech dip. All the tech stocks were down. Well, to be fair, most stocks were down because of the whole 10-year yield. And I'm not going to go into it in depth because I'm not a financial advisor. Even though I do, I'm quite clued up. I'm clued up as far as, my own personal tolerance is concerned. For any of you guys, I obviously recommend you do your own research first or speak to your own financial advisor. But yeah, for my sakes, I've done some amount of research and I was like, you know what? This is a buyer's market. This is where I want to buy. A lot of people are kind of scared buying out, so now I'm going to jump back in while people are scared. And yeah, I made these two funds. So why did I make these funds, or as Trading 212 calls them, pies? For me, one, obviously the market was down, so I kind of wanted to get in anyway. But the main reason, the big thing, was that this whole year, and even most of last year, was a bit crazy. Like, me as a student, I haven't really lived the student life. I've been trying to put out a video like what I spend in a week as a student, a day in the life of a student, all these like typical more student videos, but I just haven't had anything to do with it, sitting here in my room for about a year and a half. That's not true. So it's been a year of all these lockdowns. But then first half of last year, if you guys remember from that long, I was living in Newport and Wales, and I studied in Bristol, so it was like I've had a crazy year and a half basically. And I really want to do more in terms of student life. So I thought, you know what? September is 6 months away. You can expect maybe not expect, but I'm hopeful, I'm optimistic, thinking that these lockdowns, obviously COVID's not going to go away anywhere, but the vaccination rates are quite going up, case numbers are going down. Like, I assume by September things will be a bit nicer, at least in the UK, and hopefully in America as well. So I was like, you know what, let me just, since I've been given access to, my entire credit limit on my credit card, I was like, I'll take out 1,000, and I'll play around with that purely purely for you guys. So that's it. That's it. And my time horizon is September, so I hope that by then, obviously the promotion is a 6-month money transfer, 3% upfront fee, but 6 months of no interest. So ideally, I need to have the money, the £1,000 back in 6 months, so I can pay that off and then not have to pay any interest on that loan. Well, it's not really a loan, it's like a money transfer. But anyway, 6 months, 3% fees that I have to make up for, and then the rest is just pure game. So let's get it. So before I show you the stock, before I show you the pies, which is basically the last part of the video, as I said, I took out £1,000. I was given a £30 fee because that's 3% of 1,000. So I put it up here. The maths will be up here. There's 1,000. 3% of 1,000 is obviously £30, so that's £1,030 in total that came out of my account. Now, where that gets just, where the magic happened was I have this thing called a lifetime ISA, which I have a video about. So if you want to check out and learn more about lifetime ISAs, watch that video. But it's essentially an ISA that's designed for you to, put money aside for your first house purchase. You can put £4,000, up to £4,000 a year in there, and the government, here's the cool part: the government, and the UK government will give you a 25% bonus on that. So if you put in £4,000, they'll give you another 1,000. That's 5,000. If you put in £10, they'll give you £2.50. That's £12.50. I'm not going to buy a house with that, but it's it's good to know you can get free money from the government through this account. So I said, £30 fees. If assuming that I make the money back, I can pay this loan off in 6 months and not have any, no interest on it. But I can't avoid the fees. How am I going to avoid? What am I going to do about those fees? And I said, I thought about it. And then I realised if I put in simply £120 into my lifetime ISA, that 25% bonus will give me another £30, which basically writes the fees off immediately. And then the remaining £880 is free games I can do whatever the hell I want with. And that, that was a sound idea. However, I kind of wanted to be a bit more intricate with it. So I put 260 into that savings account, which means I got £90 of a bonus. 90? No, I didn't. I got 130, £65 as a bonus, but I did put in £100 of my own money, so I did get £90 of a bonus. I put in 360 in total. And what I did with that, even though yes, lifetime ISA, blah blah, it's the idea is that that's kind of my stuff. I'm still going to tell you where that money went into. I'm still going to give you an idea of where that money went into. So that £260 that I put into my lifetime ISA, I split up between 4 different funds. One is the AJ Bell Growth Fund. 2 is Legal & General's Emerging Markets Future World ESG Fund, and the other 2 are 2 Vanguard funds, Emerging Markets and Developed Markets ESG. So basically it's 3 ESG funds and 1 Global Growth Fund. The Global Growth is purely because I already had that in my portfolio, so it's just like adding more money to it. And the 3 ESG ones are literally because I talked about in the past, I'm very I'm very bullish on ESG, so I thought if I'm so confident, let me put money where my mouth is, put £260 straight into that, see where that goes. So that's cool. I'm not going to show that, that's on my laptop anyway. Oh, you know what, I've actually been recording this whole time and then just haven't done anything. So that leaves me, so after I take that £260 out, that leaves me with £740. So where's all that gone? I made, as I said, I made these 2 funds, and I'm going to start recording the screen again now. What's impressive about these 2 funds is one of them is my idea of like a medium to high risk fund. Obviously I expect to make profits in that in the next 6 months, but the idea is that if it goes very well, I'm going to make like hopefully a high percentage return on that. It's only £300, I'm not going to make a lot of money, but I will make a high percentage yield hopefully. And then I thought the original plan was to make this one pie. I'm going to call it a pie from now on because this makes more sense. So I'm going to make this pie and it's put all of the money in there, well the remaining 880 after I put the money in lifetime ISA. But I thought, you know what, instead of having this medium to high risk and medium to high return fund, let me make a second one, a second like a B fund, one that's low to mid risk, based on of course my own understanding of my own tolerances. Again, not recommending any of you guys buy into this, but this is kind of my thoughts on the matter. So I've got these 2 funds, one that I've decided to call, I'm in the app on Trading 212 now, so it should be up on the screen somewhere, I'll figure out later. One pie that I called the Do or Die Freshers Fund, I don't know why. The second pie I called Undergraduate Survival Fund. Both of these funds I'll put the links to in the description below, so if you do want to check them out, I encourage you to do that. Obviously don't copy and invest into it without doing your own research, but I have, you know what, if you guys want, I might actually do like a proper fundamental analysis video and explain why I put these funds in there. But fundamentally, all I want to do with this video is show you what I've got and then explain what I hope to get out of it in 6 months' time. Of course, I will do another video in 6 months showing you guys how it turned out, whether good or bad. But let's just quickly go through the funds. So the do or die Focus funds, the first one I've got open here. I put £300 in. It's currently valued at £313.85. It's been about a week, I think. So I'm up 4% in less than a week. Tesla is actually the one that's down, which is the one I was expecting to make the most out of. And Tesla represents. Well, the idea was that I set these, I put down the 15 pies, the 15 companies that I wanted to invest in, and then I thought, which ones do I want? Which ones are the most am I the most confident in? Which ones I want to have the highest weighting on my investment? So Tesla, I gave it an 18.1% rating, but at the moment it only makes up 17.24%. So the number on the right is what I expect it to be, and the number on the left is what it actually is. And I assume that's because as stocks go down and others go up, it reallocates itself. It doesn't really make sense for trading 2-on-2 to sell off immediately and keep them in line. But can I do that? Yeah, I can rebalance it. If I press rebalance at the bottom, it will just sell off some of the winners and then redistribute to some of the losers. But I'm not going to do it anytime soon. Maybe halfway through just to see how it looks. But yeah. So Tesla I kind of put in there again because I just like Tesla. I'm quite bullish on Tesla in general. AIG SA, so that is the International Airline Group, I believe, in the UK, and that's kind of more of my recovery stock. I was like, if the vaccination rates continue and the lockdown does end in June, you can expect there to be way more flights, and you'll see more of that in the other fund, but the other pie. But in this one, I put AIG in there. That's the one I expect to have the biggest rebound. And hopefully the best. Square is in here, and what's interesting about Square and Tesla is that they both have quite a big Bitcoin trend line, I guess. Like when Bitcoin does well, so because they both own a lot of Bitcoin, so they're not literally carried, weighted by Bitcoin. But it is interesting to see that. Those are my two stocks that I kind of wanted to get some Bitcoin, some cryptocurrency exposure. Mostly more so Square than Tesla, because Tesla's literally just Bitcoin, whereas Square is a crypto. I guess they're building a crypto service. But yeah, that's why Square is in there. I've actually got videos on both Tesla and Square on my channel. So if you want to know why I've invested in them in the past, check those videos out. They'll be in the iCards in one of these corners on the screen somewhere, I don't know. Next is Boeing. Boeing's another recovery stock. So is Hive. Airbnb is a combo, I guess, of tech and of recovery. The idea when it comes to Hive Group, Boeing, and Airbnb, Hive Group, for guys who don't know, is they're the guys who organize all the conferences and big meetups and meetings and stuff. Airbnb is obviously Airbnb, hotels and houses that you can rent out for holidays and stuff. And then Boeing's, of course, an airline manufacturer, so they own their planes. It's Boeing and the other one, I can't remember the other one, what they're called, but yeah. That's what these guys are. These are all recovery stocks in my opinion, because once things start going well, people start flying around more, they start going more to events once you're allowed to have mass meetups. Airbnb people they need somewhere to stay, right? So Airbnb's in there. I've also got Rightmove in here. No, I don't. That's in the other one. So yeah, I mean Airbnb is pretty cool. Neo's in here again, similar for Tesla. Neo I wanted to be a third, as in the 3-to-1 ratio of Tesla to Neo holdings, because even though I believe in EVs, and I think Neo's obviously the Chinese parallel to Tesla, I don't think their financials and their, I don't believe in them as much as I believe in Tesla, and I feel like if I put money into one, I've got to put some into the other, but much more so in favor of Tesla. Ideally, it would be like a 10-to-1 ratio, but I haven't really got money like that to be splitting things up as much as, I can, to be fair, but I believe in Neo more than I believe in some of these other ones that I put in here. So let's keep going down in the first fund. I got GHVI, what are they supposed to be doing again? Matterport. GHVI, they're a SPAC, and they're supposed to be merging with a company called Matterport. Matterport have I'm not super into real estate, but when I've been looking at student properties or somewhere to live this last 5 years, I always see certain things, and Matterport are quite widely used when it comes to giving you a 3D mapping of the inside of a property. Again, I'm not super invested in real estate, but literally everywhere I went, I would always see Matterport tech being used. And I can only imagine if they're doing a SPAC. I've done a bit of research. They do make a bit of money. They have a bit of monopoly there as well in the augmented reality space. So, I put some money into that as a SPAC. I was like, let me just see what happens. Yeah, I don't, there's not really much more I can say to that. It's quite speculative. MViz, Microvision, speculative as well. The bottom, how many are here? 5, 6? These bottom ones that all make up less than 5% are more of a hedge. I mean, to some degree they're not a hedge because Riot blockchain is quite volatile. Sundial Growers and Afria are both pharmaceutical companies, or you can call them weed stocks. Most people will call them. They're quite speculative. Virgin Galactic is quite speculative, I guess, and Rolls-Royce is literally just a hedge, a recovery stock. But I don't know. I feel like these ones offer, what these stocks offer that the rest of them don't, is that they're not necessarily as widely talked about. Like people talk a lot about Tesla, Square, Airbnb, Neo, and these stocks are of course more prone to like being not literally memed, but to some extent having a cultural balancing sort of process. Whereas the rest of these stocks, I just thought, Hyundai, no one's trying to buy, Kia, Honda, Kia, because they're not like a glamorous stock. Although I think Hyundai, Toyota as well, and obviously Kia are a subsidiary. Well, subsidiary, like a partner of Hyundai. They're doing very, very well in their EV space. Not literally making electric cars compete with Tesla, but when you look at all these other companies like Ford, Mackey's, alright, but the general, if you read into what Ford are trying to do, the general like mission for the next couple of years, it's not as future-proof as I'd like. It's a lot more. Jaguar, Land Rover, they've been talking about electric future, but they're also saying like we're not going to make electric cars until like 2030 or some nonsense. Like, they're kind of just lying to make it seem like they're doing better in the press. But when you actually read into it, I feel like Honda are going to be like a big player in the game later on, in the future. And I think Toyota already have quite a big lead because of their hybrids and their Prius, their hybrid tech. But yeah, we'll see how that goes. I don't own any Toyota, but look into it if you want to. But yeah, this is my full pie. This is the first one. This is my mid to high risk pie with some crypto exposure, a lot of tech in here, some recovery stocks. It's pretty well balanced in my opinion, but do check it for yourself, do your own research, and I will, as I said, put that in the description below. The second fund, which I actually opened a day later, and it was actually doing very, very bad relative to this one in the short term, but now that I'm checking it today, it's pretty much even. I also put £300 invested into this one. Well, this actually says 29962, so I don't know, maybe there's some variance about it, but it's now at £310.81, which is pretty solid. Both of them have my dividends reinvested. I don't actually think any of these companies do offer dividends anyway. In this one I have Apple, which do offer dividends, but in the first one I'm not really sure. I should probably double check. But what that means is that whenever they do pay my dividends, instead of me getting that in cash, it will just stay in this pie and be distributed evenly again based on my weightings. This one is wow, it's actually doing I'm happy with this one actually. I'm happy with it so far. But yeah, let's start from the top. This one has 17 slices instead of 15 like the other one. Maybe I should have just put 16, but it doesn't matter. The biggest one here is Apple. Apple, I only gave it 12.4% versus the 18.1% I gave to Tesla. And that's because even though I still expect a lot of rapid growth from Apple, there's a lot more tech in this pie, and I didn't want to invest more than like. I wonder how much I have weighted it. I think it's probably around about 30% in tech, which is actually quite a lot. They say usually 15% per sector is enough, but because like Uber isn't the same type of tech as Apple is, I thought I can be a bit more generous to myself here. But yeah, there's a bit more tech here, so I tried to be a bit more balanced. Like Apple, Nvidia, of course, make their GPUs, and Nvidia have basically at this point, I don't know if they completed their merger, but who were they were merging with someone, and I was like, I think it's AMD Nvidia merger, and I was like, if that happens, it's gonna be peak. It's just gonna be a wrap. But I've got AMD here as well. I've got Nvidia here, and I believe that when you're looking at the microchip shortages happening right now, these are the companies that are gonna blow up. Once they figure out how to solve those problems in the future. Apple as well, making the M1 chips. So these companies I think are going to do very, very well. I'm looking forward to the Apple event sometime this month in March. They always have a March event. I don't actually know much about it, but I'm looking forward to it either way, to see what they release and to see how that affects my holding here. And of course the dividends. Moderna, to some degree, I don't like having Moderna in here, because when I look at what's going on with the vaccines, I mean, they're doing pretty well. It's AstraZeneca that are more taking an L here. But I don't know, is it BioNTech, Pfizer? Their vaccines are actually way better, but I don't know. It's just for diversity, and I did a lot of research about it. They do seem like a cool company in terms of the finance and stuff like that. I can't speak on behalf of the vaccine in general because I've kind of slowed down on the COVID news, but yeah, 8.1% is actually that's actually my third biggest holding here. So I'm hoping the vaccines go pretty well, and it's up, to be fair, 30%. So yeah, maybe I'll rebalance. Maybe I'll sell some of that and rebalance it in a bit. But yeah, Moderna, shout out to them. I've got Uber in here, as I mentioned before, Uber, AMD. Disney, so this one I've got a bit more of a weighting between, like, it's like half tech, half recovery. And you'll see why as well in a minute. Because Walt Disney, Sony's not really a recovery stock. I'm just kind of banking on the PS5 performing better this year. But Well, actually, with Sony, just briefly as well to finish that, it's like people will start to get PS5s hopefully throughout the rest of the course of this year. But what's more significant is that once the lockdowns open up and people start going outside more, seeing their friends more, people won't really be buying more PlayStations, but they will be buying more games. I imagine like they'll be going out more. You'll realize, oh, my PS5, I haven't touched it in a while. Let me play something, and then you're gonna be like, oh, what can I play? What do I want to buy? You start buying more games. You start playing online more. Maybe not more per hour, but you are spending more money into it. In theory, that's my thought process. I don't know if it works out. I don't know if that checks all the boxes. But plus, even this year for Christmas, you're gonna have all these kids that haven't really had much life in the last couple of years. So it's gonna be like, you know what? If the parents might want to splash out the cash if they have any, if they still have their jobs. So I don't know. Maybe I should rethink Sony, Sony being in there. But I put Sony there. Disney, Cineworld, Ryanair, EasyJet, Calnex Solutions is like a 5G tech company in the UK. Jet2, Rightmove, McDonald's, and Scottish Mortgage Investment Fund. Like those are all, in my opinion, recovery stocks. Like Walt Disney, if you think about what everything Disney owned, like Marvel basically, all these Marvel films that were delayed last year that are gonna come this year. Spider-Man 3, Black Panther 2, I think next year or something. The Loki series is coming soon. Obviously, WandaVision is doing quite well on Disney Plus. Disney Plus itself is doing quite well. I'm just expecting Disney to kill it this year. And obviously Cineworld as well. The cinemas have been closed this whole time. I kind of wish I bought into Cineworld way earlier, but I was like, nah, let me just wait and see how things play out. Because cinemas weren't even doing that well before the lockdowns, let alone we know what I think them to do afterwards. But me, myself, I know the one thing I want to do when I finish this lockdown is sit down and watch a movie when it's cinema. That's the only time where you're just kind of doing your own thing. You're just watching this film. There's no pressure to do anything else other than watch. So I don't know. I'm kind of optimistic about Cineworld, at least in the next 6 months. Disney as well, big recovery potential there. Ryanair, EasyJet, and Jet2 are three quite major UK budget airline services. So again, once things open up, people will be flying around a lot more. And I think these three in particular, because people that lost their jobs are typically people, well, not even typically, obviously, people who lost their jobs are people that are working, whereas students who aren't working didn't lose their jobs. For the most part, their income's not really affected. I mean, if their parents get the money, then yes, it's affected, potentially, but like my income hasn't been affected at all, basically, so I can imagine, I'm extrapolating, I'm trying to kind of assuming everyone's in the same situation as me, where if they're younger, you have more money, you have the same amount of money basically, but these flights, so many kids are like, oh, you didn't get to go on holiday 2020, blah, blah, blah. Like, I imagine, even though one demographic of like older flyers might be affected, I feel like the younger generation won't be affected as much, if not, maybe not at all. Not to mention, I think there'll be a lot of people that weren't planning to go on holiday that now do want to go on holiday because of what we've been through. So optimistic about that. And even if there is no extra flyers, I feel like it's at least going to come back up, the stock compared to where it was beforehand or where it is now. So that's hopefully, my recovery mode stocks. Nintendo, the reason why I bought Nintendo isn't necessarily because I think they're going to do extremely well this year, because they've kind of been doing well since the Switch came out, but it's more so because the Nintendo Switch was like the best selling console of the year last year. I think even in February was the best selling console of the month, ahead of the PS5 and Xbox Series. So that's cool. That's, on one front, that's a cool thing because a lot of consoles are selling. But what that really means is that people are going to start buying games for that. They're going to start buying the online Nintendo services and all the things that bring in the revenue, all the software, all the skins they want to get for their Animal Crossing characters, all the stuff that they can start buying, spending more money on. So I'm hoping that there will be a massive recovery. Not even a recovery, because as I said, they're doing very, very well. But I think they're going to continue to do well throughout this year. Maybe next year it will start to cool off a little bit. But I don't know, they're underrated stock in my opinion. So I'll start some money in there. And then the last ones, Impact's Asset Management Group. Impacts are one of the biggest ESG focused firms I could find. And as I said, I like ESG. I kind of just put money in them because I wanted to be more diverse, wanted to like balance out the books a little bit. I've done a little bit of research into them. The only problem with asset managers is like if they have one bad week, well, maybe not one bad week, but if they have a bad period, it takes 1 second for all the investors to take all the money out of them, and that could be the end of their service. So it's a bit difficult. However, that's not likely to happen. But I don't know. I like their ESG focus. I like how their board is like 50% women. They seem like a very cool investment company. So I thought, you know what, let me just back it. Scottish Mortgage Investment Trust. That's because just houses, and Rightmove was also here as well because of houses. People that couldn't move during lockdown, they start moving soon. McDonald's is probably the the one stock I'm the most proud of in my entire portfolio in both of these two pies, because first of all, McDonald's in many ways is like a real estate company anyway. Like when you think about I doubt they make that much money from the chips and the fries, the burgers, whatever, versus how much money they've got in their assets. Like there's a McDonald's in every interesting area, every major roundabout is like McDonald's drive-through there, every like popular high street McDonald's. If they were to go, if there was like a global chips shortages, they'd be like, all right, cool, we're just gonna sell that Mayfair property. That's a couple billion in the pocket right there. You know what I mean? Like McDonald's are phenomenal as far as like their real estate vision, their eye for property is concerned. I feel like that's a crazy take. I don't think many people are thinking about the real estate of McDonald's. But when you think about lower interest rates, mortgages, this I put Rightmove and the mortgage trust in here as well. It's like hedge to some degree. They're both hedges because I don't think it can be as volatile. But it's like, as I said, people are going to start moving more. People are going to get outside more. You're going to see house prices already going up through the roof. McDonald's are in a prime position to capitalize on that sort of growth in theory. I haven't actually done enough research on them, to be fair, but that's cool. That's one thing that I think is really cool about the whole real estate side of it. But why I'm proud of McDonald's is because I was sitting there thinking like, lockdowns are ending soon. What are people going to start doing more of? Maybe they're going to start flying out more, so you want to buy some flights. When they go on holiday, they want to get more. They need to get a hotel, so you want to get some hotel groups in their Airbnb. Maybe they want to, get Ubers to see their friends, so you put some Uber in there. But what's one thing that that some people Uber, some people will be like flying out, some people doing their own thing. But what's one thing that every single person in the universe is gonna need more of? Like if you open outside, what's the one thing that every single person has in common? We're gonna want to eat, bro. We're gonna want to eat. We've been cooking up in our own houses for so long. Some people have been ordering takeaway, stuff like that, but me myself, I know I really want a steak. Once outside opens, I want to eat a nice juicy steak, restaurant quality steak. But that's me. What about everyone else? Everyone, if they're going on holiday, whether they're going to Europe, Hong Kong, America, whether they're just like Ubering to their friend's house, wherever people are going, there's a McDonald's there. The fries are going to be going through the roof. The nuggets are going to be going through the roof. Like, obviously I'm bantering right now. It is quite funny to me. Oh, I've come out of it. I do find it quite funny, McDonald's again. But I don't know, there's something about that as I'm like, maybe I'm onto something here. Maybe I'm onto something here. Because no matter whether you, as I say, if you want to go to your friend's house or you want to go to France, you're going to be getting McDonald's at some point. So let me just put my money where the fries are. Let me just put my money where my mouth is. Let me just put my money into the fries and put the fries into my mouth. That's what I was trying to say, but it wasn't very good. But anyway, that's it. As I said, and I'll say it again, both of these funds, both of these pies will be available down below. Just so you know, I don't get anything out of it as far as I'm aware. You literally, what I'm effectively doing with this pie system that 212 has created is people can make their portfolios, they can publicize it, and then people that want to buy into their portfolio can like copy that. So you'll look at whatever I've got at a time and then copy that and then buy into it on your own. I'm not like a fund manager. I'm not some asset manager. As I said, I'm not a financial investor. I've got no idea what I'm doing with this. I just thought it'd be fun to do as a little side project. Hopefully, again, if I can make £500 from both of those, well, like if I can make £200 profit from both of these, which is 66% growth between now and September, that will entirely pay off, the £1,000 that I took out of Aqua. That way the money that I put in my lifetime ISA can just go to my house in the future, and that basically is from you guys. Even though it's not at all, I'm going to take that as the truth in my heart. So we hope for the best, and yeah, that's effectively it. So I hope you guys have enjoyed it. Pat me on the back. Hopefully we all make some money together. Peace.